All right, here we are with another problem. This one's going to be for chapter 11 and 7 as well. All right, got a little meme for you. Obi-Wan says, Luke, you must learn the ways of the Force. I'm ready, Obi-Wan. Okay, let's see here. After you've logged in, you're going to want to go to the student portal and click Jedi. I'm a sucker for Star Wars. That one got me. All right, here's the problem. All right, so right, this is going to cover topics from chapter 11 and 7. All right, I think the hardest two chapters from this last material. Dawn is single. She forms a rock band on January 2nd, 2017. All right, so she conducts the rock band as a business, right? We're assuming she satisfies the requirements. It's an active trader business. She acquires all of her equipment on January 2nd, 2017, and does not dispose of any of it before 2019. On July 15th, 2019, the band's amplifiers, speakers, and other electronic equipment are stolen after a concert. The stolen equipment's adjusted basis is $15,000. Original cost was $20,000. The insurance company reimburses Dawn $23,000. All right, so when you have your business assets stolen like that, we call that a casualty loss or theft. All right, and if it's a business asset, right, those aren't limited. It doesn't have to be a federally declared disaster. Those are deductible losses. So it said her initial basis was $20,000. Her adjusted basis was $15,000. All right, I can see that and know that must mean she had claimed depreciation of $10,000. Nope. $5,000. Okay. And we're told that the insurance company reimburses her $23,000. So now I can figure out the amount of my gain. It's going to be a casualty gain or loss, but also these were depreciable assets used in the business for more than a year. So they're also 1231 assets. So what I'm going to have here, first of all, I can see, right, she got insurance money that was more than her initial basis, right? So she's going to have an amount, a realized gain of amount realized minus adjusted basis of $8,000. $5,000 of that is just due to depreciation, right? So up to the amount of depreciation, we have to recapture as ordinary income. All right, that's because of section 1245 recapture. Uh-oh, I'm coughing. The remaining $3,000, right, and I can see, right, that's the difference between the initial basis and the actual increase above that they got at the sale. That's going to be 1231 gain, right, but it's also a casualty gain. All right, I want to keep track of the casualties because I have to net them together first. Next, it says Dawn's road bus runs off the highway on September 13th, 2019. Driving under the influence suspected by me. The bus has an adjusted basis of $40,000. Original cost $65,000. Let's go. Initial basis $65,000. Adjusted basis of $40,000. All right, so I can tell the accumulated depreciation was $25,000. But after I wrote all that down, the problem just tells me after the insurance reimbursement, she ends up with a casualty loss on the bus of $6,000. All right, so I didn't really need to know all that. I'm gonna have a $6,000. All right, this is a 1231 casualty loss. Let me write bold the things I need to come back to. All right, so we The problem just tells us what we need to know. We could tell from that. All right, so she must have got, right, if her adjusted basis was 40,000, the insurance must have given her 34,000 for a $6,000 loss. All right, next, Dawn sold the building she used for band practice. She bought the building in January of 2017 for $50,000 and sold it in September of 2019 for $52,000. Right, so it was, a depreciable asset used in the business for more than a year. All right, so this is going to be under 1231. Initial basis was 50,000. I mean, who has $50,000 to start a band? Trust fund. Okay. The amount realized is 52,000. And she's taken 10,000 of depreciation deductions. Okay, so we could tell from that her adjusted basis must be 40,000. 50 minus 10. All right, so from this, right, once again, I can see she's going to have a gain, amount realized minus adjusted basis of 12,000, right? But up to the amount of depreciation of that 10,000, in this case, right, we would recapture it if it was personal property, but because it's real estate, we're going to call that unrecaptured section 1250 gain. The remaining, right, there's going to be, the rest of the gain is going to be just a 1231 gain, right? I can see that, right, the difference between the initial basis and the sale price, right, because there was an actual increase in the value. That part is going to be the 1231 gain. All right, so now we've details regarding Dawn's other transactions during the tax year 2019. She sold some equipment, right, from 2017 in November, right? So she used it in the business for more than a year. We've got her cost, depreciation, and her sale price. I've heard my kids screaming in the back. Soundtrack of my life. All right, so from this, right, I'm just gonna kind of eyeball these, right? Hopefully you're kind of understanding how this is working, right? So I can tell that there's been, since she sold it for more than she paid for it, that amount, right, that difference of 5,000, that's going to be a 1231 gain, right? Because it's a 1231 asset used in the business for more than a year, right? The depreciation amount, 6,180, that is going to be ordinary income, right? Because of 1245 recapture. All right, you can see her adjusted basis would have been about 6,820, right? So her total realized gain would have been 11,180, right? So we have to recapture up to the amount of depreciation. The rest will be 1231 gain. Guitar, her original cost was 25,000. She sold it for 5,000. Here we can see, right, with the accumulated depreciation, initial basis minus depreciation, she had an adjusted basis of 9,600. Kids, man. Okay. Right, so with that adjusted basis of 9,600, right, since her sale price amount realized was less than that, she's going to have a loss of $4,600, right? This was, right, because this is her business, right, this is a business asset to her, Huge disappointment to her parents. This is going to be a 1231 loss, right? Let me put this as a negative number. All right, next she sold some stock. Right, I told you she was a trust fund kid. Okay, IBM stock, right? We can see that she's held this for much more than a year, so this is going to be long term. Bought it for 1,500, sold it for 3,000, so this should be a $1,500 long-term capital gain. Shares of GM stock. This we can see she has held for 12 months or less, right? Less than 12 months. So this is going to be short term. She bought it for 12,000, sold it for 4,000. All right, so she's going to have an $8,000 short-term capital loss. Finally, she had some Dell stock, right? This was also going to be short-term, right? She held it for about 10 months. Bought it for 15,000, sold it for 20. This should be a $5,000 short-term capital gain. Lastly, we're told that her taxable income before all these transactions is 100,000. All right, so I'm going to note that. So we want to find Dawn's taxable income and her tax liability. All right, so I think I've analyzed everything here. I'm going to put it into an organized form here so I can net everything. All right, so first she's got, all right, we're told she had $100,000 of taxable, right, ordinary income before all these transactions. From the loss of the equipment, she had some ordinary income from recapture. And she had a $3,000 1231 casualty gain. All right, so I'm going to keep a separate column here for 1231 casualty gains and losses. All right, because on the bus, she had a $6,000 1231 casualty loss. Okay, on the building, right, is real estate. So we have this unrecaptured 1250 gain. Right, I'm going to keep a column here for 1250, unrecaptured 1250, section 1250 gains. And we had a $2,000 1231 gain. Okay, next, the equipment gave us a $5,000 1231 gain and 6,000 of 180 of ordinary income from recapture. All right, due to depreciation on personal property used in a business. Okay, the guitar gave us a 1231 loss of 4,600. All right, the IBM stock was a long-term capital gain. Right, I'm going to put that in the right 0, 15, 20. Right, those are the percentages it could be taxed at. And let's see what else. The GM stock was a short-term capital loss. Right, so I've got a short-term and a short-term capital gain of 5,000 from the Dell stock. Okay. All right, so I think I've entered everything here. The first thing I want to do, all right, let's see. I've separated my long-term and my short-term. First thing I want to do is I'm going to go to my 1231 casualties because I want to see if I have a net casualty loss, right? And we can obviously see here that we do, right? When I net these together, I end up with negative 3,000. Now, if this had been positive, if this was a net gain, I would just move it over here with my other 1231 and treat it like all the rest. Right? But because I have a net loss, right, it's a casualty, you're supposed to get relief for that. I get to claim this as an ordinary loss, even if I have other 1231 gains. Right? When I have a net casualty loss, I get to claim it as an ordinary deduction. All right, so I'm done with those. I moved them over here. Now I'll net my other 1231. Right, notice I do have a loss here. I'm going to net it against these 1231, pure 1231 gains before I net it against the 1250 if I get there, right? And so I'm going to net these. I think I get 2,400 positive, right? So it doesn't end up affecting this 1250 gain. It stays at 12,000. Unrecaptured 1250 gain to be accurate. All right, so now that I've netted these, I can put them over there, right? A net 1231 gain gets treated as a long-term capital gain. And right, we keep our unrecaptured 1250 gains in their own column, right? Because they could be taxed up to 25%, right? Higher than my other gains, right? And in this example, we don't have any collectibles gains, right? Maybe Dawn owned a guitar she didn't use in the business. She owned a guitar that used to belong to Paul McCartney, right? So it was a collectible. She sold it, right? That gain would be here, right? A collectibles gain. Right, in this problem, she didn't have any. All right, so now, right, we're done over here, right? We've netted this and we've moved it over here. Now we're just working here. So I want to net each column within itself first and see where we get to. Only one thing here. So 900 here. Going to have a $3,000 net short-term capital loss in my ordinary income. Boy, that's going to get to be some tricky math. Right, I'm anti-technology, right? I resist using Excel's features. Boy, well, now it's getting complicated though. I give up. All right, let's just. Okay, my ordinary income there. Right now I've netted within each column. Now I can net across, right? I'm always going to go over here and start on the long-term side. I don't have anything. I've started right here. I don't have anything here. I'll move down, right? This is a gain, right? So I leave it. Well, what I'm looking for right now is losses, right? Because I have to allocate my losses. No losses here either, right? So I don't have anything on the long-term side. Next, I'll go to my short-term capital gains and losses, and I do have a net loss here. Now we know that up to 3,000 of a net capital loss can offset ordinary income. So it's tempting to do that, but first, before it can do that, those short-term gains now, they have to offset any long-term gains. All right, so I take it and I'm starting at the highest category, there's nothing, right? But if we had, like she had said, she had that gain from selling a collectible guitar, this would offset that first. But there's nothing here, so now we move down to here. So now this 3,000 net loss is going to go here. That's going to make this go down to 7,000. This one's still 3,900. Now that short-term capital loss is gone. All right, so it never got to offset ordinary income. All right, so now I'm done. I've netted everything. Her total taxable income is going to be this plus this plus this. If I wanted to calculate the tax liability, I'm going to assume you guys are pretty good at that. I mean, I know you are. I've seen it. Right, so we're told Dawn is single, so I would look here. First, I'm going to take the ordinary income. I'm going to find, right, she's going to be in this 24% bracket. All right, so I would just use the formula to find the tax liability here. Next, I would go here and then here. Right, next I'm going to go to the 25% because I can fit it in here at the ordinary rate, right? That 7,000 plus her 108, right? She's still going to be within this bracket. So I can tax this at 24%. Oh, that's nice. All right. All right, so it's going to get a 24% tax rate. All right, this is all, even the 1231 gains that got in here. Now they're just being treated like long-term capital gains, plus my real long-term capital gain. I want to look at the long-term capital gains rates, right? Now, right, I'm going to count all the income that got taxed at the ordinary rates, which is her ordinary income, and this unrecaptured 1250 gain, it got taxed at ordinary rate. So she's up to 115,180, right? Which is still, right, well within here, right? So these, let me see if I can copy the formatting here so that I can go 0.15, right? These are going to be taxed at 15%, right? So ordinary rates, these ended up getting taxed at the ordinary rates period because they fit. The maximum they could have been taxed at is 25%. These get taxed at the most common long-term capital gains rate of 15%. All right, so that's the solution to this problem. See what else I got here. For you office fans, coronavirus, COVID-19, Chinese virus. Actually, it's SARS-CoV-2, Big Rona, speaking in Mandarin. I got one more. You guys are more meme savvy than me. Here you go. Because of coronavirus, due to the ongoing situation regarding COVID-19. All right, hopefully that problem helped. Let me know if you have questions. I'll try to get up a few more of these soon, right, this week.